Imagine two people walking into the same bank. They use the same doors, the same counters, the same logo hangs above them, but one waits 40 minutes, the other waits 40 seconds. One gets a script, the other gets a direct phone number. One asks for help, the other gets asked for advice. The strange part, they might be the exact same person, just at different stages of life. And that is where this story begins. Not with wealth, not with success, but with a negative $4 balance, a coffee, a forgotten charge, and a lesson most people never realize until years later. A lesson about how institutions actually work. Because what happens next isn't about banking, it's about power, and power hides inside numbers. The account was overdrawn by $4, not 400, not 4,000, 4. A tiny mistake, the kind you assume can be fixed with a quick phone call. Instead, the fee arrived, $35. Then another charge processed, another fee, then another consequence, and suddenly a $4 problem became a $200 problem, not because of spending, because of penalties. That was the first shock, the realization that being broke carries its own price tag. The less money you have, the more expensive every mistake becomes, and nobody explains this when you're young, because from the outside, banks look neutral, like roads or electricity or water, services everyone uses equally, but they're not. They're businesses, and businesses rank customers. Most people simply don't know where they rank, not yet. The first rule of money is simple. The price of money is the highest for the people who need it most. The people with the least cash pay the highest fees, the highest rates, the longest waits, the fewest exceptions. And that's where the psychological shift begins. Because eventually you stop feeling like a customer, you start feeling like a problem. The hardest part wasn't the fees, it was the invisibility. You walk into a branch, ask a question, wait on hold, explain your situation, and nothing changes. Nobody is rude, nobody insults you, nobody openly rejects you, but you feel something anyway, indifference. And indifference has a unique kind of cruelty, because it never announces itself. It simply reminds you that your problems aren't important enough to interrupt the system. Then something changes. Not your personality, not your intelligence, not your work ethic. A paycheck starts arriving consistently, every 2 weeks, predictable, reliable, trackable. And suddenly the machine notices. The fees disappear. Credit offers arrive. Approvals become easier. Responses become faster. The same institution that ignored you yesterday starts sending invitations tomorrow. What changed? Not you, the pattern, the predictability, the profitability. And that realization is unsettling, because it means the bank was never evaluating your character, only your value. Most people think banks measure trust. They don't. They measure probability. Probability of repayment, probability of deposits, probability of future revenue. The moment your numbers improve, their behavior improves. The first credit approval feels like validation. A letter arrives. Congratulations, you're approved. A small limit, nothing life-changing, but emotionally it feels enormous because somebody finally said yes. Except that isn't what happened. The bank didn't suddenly believe in you. The bank finally believed in the math. And there is a difference, a very important difference. One feels personal, the other is purely economic. Many people spend years confusing the two. As savings grow, another strange thing happens. The bank starts reaching out first. A relationship banker calls, introduces himself, asks about your goals, offers help, provides a direct number. At first, it feels flattering until you remember the overdraft, the unanswered calls, the long hold music, the automated responses. Suddenly, a question appears. If they could provide this service now, why couldn't they provide it before? And that's when another illusion breaks. Because service quality was never universal. It was tiered. You simply moved into a higher tier. Attention is one of the most valuable financial products in the world. Most people think wealth buys luxury. Wealth buys attention, speed, access, priority. And those advantages compound just like money. At higher balances, money itself becomes cheaper. Loans become easier, rates become lower, fees become negotiable, problems become solvable. One email reverses charges that once felt permanent. One phone call accomplishes what used to take days. You begin noticing something uncomfortable. Rules aren't disappearing, they're becoming flexible for you. And if rules can bend for one person, they were never rules in the first place. They were priorities. The middle class believes institutions run on policies. The wealthy discover institutions run on relationships. Policies govern the crowd. Relationships govern exceptions. And exceptions are where the biggest advantages live. Eventually, the bank gives you a title: preferred client, priority client, private client. The wording changes, the message doesn't. You matter now, not because of who you are, because of what leaving would cost them. Competitor banks begin calling, offers appear, rates improve, perks expand. People compete for your business, and for the first time, leverage enters the story. Because leverage changes every relationship. When someone needs something from you, the conversation changes, the tone changes, the speed changes, the rules change. And the wealthier you become, the more often that happens. Then comes wealth management, and something subtle occurs. The bank stops selling products, it starts selling guidance. Meetings become longer, questions become deeper. The conversations aren't about checking accounts anymore. They're about taxes, inheritance, structures, generational planning. The institution isn't focused on today's transaction, it's focused on tomorrow's assets. And tomorrow's assets are far more valuable. The richest clients aren't profitable because of what they buy, they're profitable because of what they keep. Relationships lasting decades are worth more than products lasting months. Then comes private banking. This is where most people imagine wealth begins. But private banking isn't really about money, it's about friction, removing it, reducing it, eliminating it. Problems get solved faster, documents move quicker, approvals arrive sooner, conversations happen directly. Entire layers of bureaucracy disappear, not for everyone, for you. And that's when the biggest realization arrives. The wealthy don't live in a different economy, they live in a different version of the same economy, one with fewer obstacles. Poor people spend energy overcoming systems. Wealthy people spend energy directing them. That difference changes everything. Then comes the level very few people ever see, the level where access is no longer the reward, influence is. At this stage, institutions don't simply serve you, they listen to you. They ask what you're seeing, what you're investing in, what you're expecting. Your opinion becomes valuable, not because it's always correct, because your position gives you perspective others don't have, and perspective becomes a product. The bank that once charged you for being short on cash now wants insight from you, not your money, your thinking. That is the final transformation. Not customer, not client, not preferred client, partner. Every institution has a hierarchy. At the bottom, people follow the system. At the top, the system follows people. And now we return to where this story started. A negative $4 balance, a coffee, a forgotten charge, a fee. Someone is staring at that screen right now, feeling frustrated, feeling tired, feeling invisible. They believe the system is broken, but the uncomfortable truth is that the system is functioning exactly as designed. Because the bank does not become different as balances rise, the bank reveals itself. At one level, it charges penalties. At another, it waives them. At one level, it gives scripts. At another, it gives direct numbers. At one level, it enforces rules. At another, it negotiates them. The person never changed. The institution never changed. Only the economic value of the relationship changed. And once you see that, you start noticing the same pattern everywhere. Airports, universities, healthcare, business, politics. Every system claims equality. Most operate on value. The bank simply makes it easier to see, because behind every balance is a ranking, behind every ranking is attention, and behind attention is power. The final lesson isn't that money changes people, it's that money reveals how institutions see people. The person with $25 million and the person overdrafted by $4 may be the same human being, the same intelligence, the same character, the same dreams. But one receives a fee and the other receives a phone call. Not because one became more worthy, because one became more valuable. And that distinction explains far more about the modern world than most people ever realize.